Okay, who do we have? So there is a bit of a theme that you will hopefully have picked up today, which is what are insurers or asset managers like Securus or brokers doing to go beyond the sort of traditional way of modeling? And actually, we've got two people from two organizations that are definitely a couple of the leaders in this. So Inigo, you're founded in 2020, specialist high-risk insurance and reinsurance provider. You raised over $1.3 billion in capital. I think you've got about the same amount in premium coming in now. So quite a successful startup, but you actually hit the ground running with some people, with some characters that are quite well known in insurance. And Ruth, your principal risk scientist. Vinay, chief risk officer from Apollo. You've got a broad range of specialty insurance, and we actually had some of your colleagues on stage last time talking about your smart follow syndicate. You're also looking at digital embedded, and you now support the Norman Max. Not quite sure they're a syndicate. I guess they are a syndicate. They are a syndicate. Okay. And they are bringing global catastrophe parametric insurance, and we're actually going to be doing some more with them later this year as well. And you're supporting them through Syndicate 3939. So a lot of things going on at the sort of cutting edge of what's happening. But Ruth, just picking up a little bit on what Paul was talking about for the hurricane season, and he mentioned it in there, but I was very intrigued about it. The Saharan dust bowl or dust explosion, and how that influences hurricane activity. But just building a little bit on what Paul talked about, where are we just now in the?
Yeah, no, I couldn't agree more. We're certainly, you would expect this to be a little bit of a quieter time of year with the dust outbreaks. But I think Beryl was, should not have been unexpected, given the way the sea surface temperatures were. We've got, warmer sea surface temperatures in the Atlantic than our average for the time of year, so at peak season. So it's not surprising that we have a storm early in the season that looks like a mid-season storm. One of the interesting ones about Beryl as well is that we measure, we have a metric called ACE, Accumulated Cyclone Energy, that we sum up over the whole season. And just from this one storm, Beryl, right at the start of the year, we've already got an ACE that is what we would expect at the start of September. So I think that that's kind of indicative of where we could be going with this season. So we've got this lull, and then, as Paul pointed out, we're likely to see more favourable conditions that are starting to develop sort of early August and then into mid-August as things really start to pick up.
We love a new acronym. Is that an Inigo acronym?
ACE? No. That's a meteorological one.
Better. Accumulated Cyclone Energy.
Yeah, it's just a measure of energy, and we sum it up over the whole season, and it gives you a measure of how bad it might be.
Right, and it's going to be bad. Okay, you heard it. Right here, heard it first. And then in your role, so you support. I guess you support your colleagues on the underwriting side, but also on the portfolio management side. They're using models to do that. But can you just talk a little bit about how that works? What does your sort of average day look like, if there is such a thing?
Yeah, so I mean, primarily we are focused on developing the views of risk for the different perils. So whatever peril that happens to be. The one, of course, that we're thinking about a lot is US hurricane, and in particular, one of the Inigo strategic aims is to understand climate and climate change, and the way that we interpret that for our view of risk for US hurricane is to say, what is our best estimate, our best view that we can faithfully represent the climate change that has occurred to date, or our present day view of risk? How can we really augment and understand where we are today before we start thinking about the future? Where are we today? So that is where I spend a lot of my day today, trying to understand where our risk is today and what that really looks like. And that then feeds into the underwriting. And then obviously for US hurricane, it feeds into capital management as well. And I guess on the portfolio management side, it's about thinking about, what about all the other risks? For example, US wildfire, another one that is, strongly tied to climate change, and how can we then, as time moves forward, how can we manage our portfolio in a changing climate?
Right, and there's a few others in the organisation that are looking at this, but I mean, that's quite a lot of responsibility and a lot of work to do for an organisation with $1.3 billion dollars or pounds of premium?
Past dollars, probably.
Yeah. So how big is the team sort of working on this?
So we are 3, soon to be 4. So it is a lot of work, and it keeps us all very busy. So yeah, definitely.
Good. Well, yeah, let's see how this season develops. And then Vinay, so Norman Max, parametric insurance is getting more and more interest. That, I believe, was the part of the New Paradigm Underwriters organization. Can you just talk just a little bit about what Norman Max is doing and what you're working with them on?
Yeah, absolutely. So Norman Max are providers of natural catastrophe peril parametric insurance. Try and say that quickly. And what they came to us last year with a book of business that they currently write within the US, and it's very much US homeowner focused. And they came to us with a proposition as to how they could take their IP and the products that they developed and try to create a product and an offering that could be leveraged through the Lloyd's market to make that a global offering. And so they came to us, they partnered with us with a view of establishing a syndicate, which we stood up in May this year. And we started the initial conversations very much thinking about nat cat products that were either wind or quake and US focused. But actually what we found in interest in the broker community and with the client community is actually something that's really quite different to where we originally started. So the premise, if we think about insurance is often very dull and boring, but actually what they came to us with was a product that's very ESG-friendly and focusing more on the S in the context of natural perils and looking at the protection gap. So for US homeowners and for SME homeowners, the businesses that often are finding the cost of insurance rising quite rapidly in the context of the experience that we've had over the last 5 to 10 years, could they develop a product that could help that client base? And that's what they've developed. That's what we are seeking to develop and offer more in the Lloyd's market. But actually what we found is that there are other elements of ESG that are coming through. So for example, I was speaking to the active underwriter last week, and there was a reef in Costa Rica, I believe, that was looking for parametric insurance that could help, from a government perspective, help to ensure that that reef would continue to grow and develop. And so when I look at the products that are coming through, and it is truly global, we're getting quite a lot of interest from the US to Australia, it covers those aspects of E and S from a product offering perspective, and that's quite unique from a Lloyd's perspective. And so what we've been able to develop and what we hope to develop and curate over a period of time is a product offering that is parametric based and covers all sorts of elements of perils, but also can help from an opportunity perspective, which really is the rationale of insurance.
Yeah, it's really helpful because I tend to assume ESG is all about environmental, but your point there is very important about that protection gap. And how is that then sold? Because does that go through a traditional broker network, or is you have to find a different way to distribute that as well when you, or for Norman Max?
So there's an established broker network that exists in the US, and what we've been looking to develop in partnership with the Norman Max team is a agent-led and broker-led sort of proposition. But interestingly, we have a product that we market out, but as we raise awareness of the proposition, we're actually having more people come to us say, we've heard about this parametric product, could you help us over here? And so there's a mixture of dynamic, and a large part of what we'll need to do is an education program, because it isn't just traditional insurance, so that gives us the opportunity of marketing in slightly different ways. But therein lies some of the excitement of taking a new product into new areas.
There you go. You see excitement. It's not, insurance is not dull and boring. You've actually you converted yourself to being excited. And Vinay, your role, Chief Risk Officer, so you've essentially got to make sure that the underwriters and syndicate don't kind of stretch the capital too much or don't blow up the businesses. I guess, is that your main part of your job?
So I see my job as being, well, it has multiple facets as being Chief Risk Officer. It can be Chief Warrior, but it can also be Chief Opportunity Officer. And so what I truly believe is if you can get your hands around risk, it gives you the opportunity to maximize the return on that risk. And so a lot of what we do is thinking about, so building on Ruth's point, if we can understand what's going on in the dynamics of climate risk and the different elements of the perils that we're seeing, we'll never be perfect. We'll never get it 100% right. But if we can get it broadly there and estimate what that looks like in terms of pricing, portfolio management, capital, it gives us the opportunity of seeing how we can still look to grow and develop different portfolios. And we have 7 syndicates under management, which gives us lots of different areas to think about how those dynamics of risk come through, particularly in the context of climate risk.
Yeah, fast-growing, agile. Ruth, just to pick up on Vinay's point about dynamic, you're looking for new views of risk. You're working with Reask. When you sort of look out there as to who to help you do what you need to do, what are you sort of seeing specifically of interest from Reask?
So, I mean, we've been using Reask for a bit over a year now, and Reask has been pretty much instrumental in helping us build our US hurricane view of risk. So the way that Reask is constructed is that, each year in the simulation is climatic. It has a tag and it tells you what the sea surface temperature conditions were and what the El Nino or La Nina state might be. And that flexibility that Paul was talking about earlier is where you really begin to leverage the data. So you can look at the Reask data, you can look at these many thousands and thousands of ensemble members, and you can say, well, this particular one here and this particular one there, and we look very much like our current climate. And so we can put those together and we can say, that's what we think our current climate is like, and that's how we start to build out our view of risk. One of the really brilliant things I think about Reask is that you're getting landfall information. So when you look to a lot of scientific studies, and the Knudsen paper being the big one in our industry, it's talking about basin statistics. So normally what you might have to do is you'd have to go from what's the basin number to what's the landfall to then what's the loss. So Reask is taking out one of that bit of uncertainty for us, because I can't go to an underwriter and say, I think there's going to be 23 storms in the basin this year. There you go. That's a great piece of information. It's not helpful. So what we've been able to do with the Reask data is say, we think this is the change due to climate, but then we've developed in-house our own methodology to say, well, okay, we've got this change in landfall rates across the US. That's fine, that's great. We've changed that now into what we think might be a loss. And now I can take that to an underwriter and say, I think there's this change in loss. And then they can take that and start to bring their decision-making processes in there.
Yeah, I mean, it's the theme we're talking about, really, which is the analytics are getting more complicated. Jamie explained just to the sense what you're talking about in terms of all the different variation in the scenarios, and they together as ensembles. But in a sense, there's a sort of translation required to make those into practical use for the underwriters and take the academic view and actually convert it into something that's, as you say, usable. Vinay, how does that play out for what you're doing? I mean, more specifically on Reask, how have you done with Reask so far?
So we, excuse me, as part of the initial setup with Norman Max, they came to us with quite a different portfolio to a normal UNS, DNF or binder portfolio. And so the traditional way of looking at that risk profile would be through a CAT model, but actually the risk characteristics are quite different. And so what I wanted to do, and on behalf of our board, was to have a second view of risk, which would give us a sense of how is that portfolio different to other portfolios in the market. So it gave us confidence as a board that what we were doing in terms of thinking about the risk profile, the pricing, the capital, that it all made sense. It was really helpful in terms of our representation to Lloyd's and to any other stakeholders to think about the risk and that we'd assessed it appropriately. But I think what I'd love to do more of, and I think is that prospective view of how we use data. So the vendor models are amazing in terms of what they've been able to do for us for the last 20 or so years, but it's very backward looking, which is no criticism, it is just where we are. So the ability of using some of the Reask data to have a prospective view really then helps in terms of how do we think about shaping portfolios over the course of the next year or the next 2 years. And typically, underwriters will have a view that we will always write around a risk over the course of the next 12 months. And I'm pleased to no longer be the heretic when talking about climate change and underwriting committee. But it's how we use that data to really then make a difference. So that so what element of all the science, how do we translate that into really shaping a portfolio as we go forward?
Yeah, and also the challenge, of course, the more information you have when he's looking out into the future, the more uncertainty there is. So you've got to basically make decisions with more uncertainty in there. So it's a dangerous game, isn't it? I mean, for both of you, sort of, have you got a version of Ruth at Apollo that helps you and your colleagues sort of make sense of the science, or is that you?
So from our perspective, so I have an amazing team that help to inform that view, and some of the team are here. And it's very much, some of it is a leap of faith, but it's the credibility that builds up over time that helps to inform that view. And it's a collaboration effort between pricing, exposure management, underwriting, capital. And so if we look at this together, look at what our appetite will enable us to do, I think it gives us the ability to have that grown-up conversation as to what can we do.
Good. And then Ruth, just one final word from you. So, because we record this, as a scientist who's ended up in insurance, where are you? If you could compare academic life where you came from versus insurance, what's your sort of recommendation for people looking to build their career? Stay in academia or go into insurance?
Go into insurance.
Right. On that happy note, I think we'll close there. Thank you very much.
Thanks.
Thank you, Becky.